Welcome back to 5 Minute Smart, your daily 5-minute lens into global finance, macroeconomic shifts, and technological frontiers. I am Liam.
And I am Alice. Liam, a historic seismic rotation is unfolding across global financial markets. Spot gold has surged past $4,660 per ounce, hitting fresh all-time highs and staging a massive rally from early August lows.
This is not just a standard commodity rally. What we are witnessing is a fundamental vote of no confidence in fiat sovereign debt as the United States national debt officially crosses the staggering $40 trillion threshold.
Exactly. Investors are waking up to a structural reality. 30-year Treasury yields remain uncomfortably elevated, near 5.3%, while Treasury Secretary Scott Bessent has been forced to double long-term bond buybacks to $4 billion per operation to keep the yield curve from spiraling.
That unprecedented intervention, what institutional desks are calling the Treasury's yield curve twist, has raised deep questions about the long-term sustainability of American fiscal discipline and the Federal Reserve's true independence.
And it goes far beyond retail or hedge fund speculation. The latest World Gold Council data reveals that global central banks accumulated gold at record volumes throughout the second quarter of 2026, continuing a relentless multi-year de-dollarization campaign.
Sovereign reserve managers in Asia, the Middle East, and across the global south are systematically trimming their exposure to U.S. treasuries and reallocating billions into physical gold bullion to insulate their reserves against debt monetization and sanctions risk.
Think about the dynamic here. While Western equities trade at historically stretched valuation multiples and bondholders suffer real-term negative yields, gold has emerged as the ultimate pristine, counterparty-free reserve asset.
Even with the Federal Reserve maintaining an opaque hawkish posture under Kevin Warsh, ahead of Jackson Hole, the gold market is completely disregarding conventional real rate models. Gold is rising in tandem with higher bond yields, breaking decades of historical correlation.
When an asset rallies despite elevated interest rates, it tells you that the market is pricing in systemic fiscal debasement rather than cyclical inflation.
This brings us to our signature segment. Alice, for our listeners heading into executive boardrooms, client presentations, or investment committees, what is today's smart-sounding sentence?
Today's smart-sounding sentence is, gold's ascent past $4,600 is not a speculative anomaly, but a structural repricing of sovereign risk, as $40 trillion in fiscal debt accelerates the global transition from unbacked fiat paper to hard physical reserves.
That encapsulates the entire macroeconomic paradigm shift. Alice, how should our listeners explain this when speaking with colleagues?
Explain that traditionally, high interest rates depress gold prices because gold pays no yield. But today, the massive $40 trillion debt burden makes real bond yields suspect, forcing global central banks and institutional capital to treat gold as the ultimate hedge against sovereign solvency risk.
In essence, when governments weaponize debt and print trillions to service interest costs, gold ceases to be just an inflation hedge. It becomes an alternative monetary system.
Precisely. The sprint to $4,600 is the market's loudest warning siren that the era of risk-free government debt is officially over.
An indispensable insight for every modern investor navigating this macro storm. If you appreciate these sharp, signal-rich daily briefings, please hit subscribe, give us a thumbs up, and share this episode with your network.
You can also support our independent financial research directly through the Ko-fi link provided in the description below.
Thank you for joining us on 5 Minute Smart. Stay sharp, stay informed, and we will see you right here tomorrow.